Hi everyone, this is Steve Elwell, Chief Investment Officer and Partner at Level Financial Advisors, and this is your first quarter 2025 commentary. It was a bit of a bumpy quarter with all sorts of new information coming along regarding tariffs and U.S. dollar movements and economic policy in the first 100 days of a new presidential term. And all of those moving parts provided a lot of information for the investment markets to digest and try and figure out. So let's jump right in and see what happened this quarter. Beginning with the U.S. stock market, down 4.72% for the quarter. Mainly big U.S. Growth stocks and small U.S. growth stocks leading the decline for the U.S. stock market. But fortunately, diversification has paid off very nicely in the first quarter with international developed stocks up 6.2%, emerging market stocks up 2.93%, global real estate up 1.37%, and the bond market had a good quarter as well, up 2.78% for the quarter. To put into context just how good of a quarter that is for the bond market, if you were to annualize the returns for those 3 months, the bond market would be looking at a positive return for the year of around 11%, which would be well above average. I don't know whether the bond market will continue to have a growth pace that's quite that fast over the rest of 2025. But nevertheless, bond market off to a great start. And same story even with the international developed stocks. I mean, if you were to annualize the 6.2%, you'd be talking about 24-25% return for the year, which would be an unbelievable year. So a divergence between the U.S. stock market and just about everything else. As we dive a little deeper into the U.S. stocks, just to see exactly which categories did what, U.S. large value stocks actually were positive for the quarter, 2.14%. Whereas, as I mentioned before, if you look on the middle right part of this chart, large growth down 9.97 and small growth down 11.12. Those growth stocks, specifically the larger ones, really had been what's leading the U.S. stock market forward in 2023 and 2024. It had been essentially the best performing asset class over those two-year period. Specifically the Magnificent Seven, which is kind of a Wall Street nickname for 7 of the largest tech companies: Tesla, Amazon, Apple, Microsoft, Google, Meta. So, all these different companies that NVIDIA, which has really kind of been the main leader of that pack. Big pullback on those holdings. In previous quarters, we had showed kind of a lot of visuals that just showed how expensive those stocks and that asset class was getting. And that wasn't necessarily a prediction that things are about to take a downturn or that things are about to returns in that category aren't going to be good anymore, or even positive going forward. It ultimately was really just showing that often investment categories get a little overheated, and then if expectations aren't met, they tend to cool off, or if new information is provided, or a surprise of information is provided, they tend to either cool off or underperform for a while. So this is a pretty big reversal if you look at that, that chart, right? That's a 12% swing in 3 months between large value and large growth. So a pretty quick correction of valuations. That doesn't mean that things are back to like historical averages. There's still a long way to go before that ends up, actually being the case. But we thought we would just sort of highlight, not only the differences of what happened in U.S. stocks, but the differences in what happened globally in the stock market, and just how important diversification still is. We had read and heard so many different things from investors over the last few years that really questioned why would anyone really own anything other than the S&P 500, or more specifically, anything other than those magnificent 7 companies that were basically leading the entire stock market higher over those last few years. And this is the reasoning is that new information can come to light or expectations cannot be met sometimes, and then ultimately that leads to a reversal. There is no one thing that always does best in the investment markets. If that was the case, there would be no point in holding anything else. And so, another quarter here where we look at things and say, thank goodness that we have diversified the portfolios appropriately. So we were somewhat cushioned from the decline that happened in the U.S. stock market as a whole. And if we dissect over at the bond market, some interesting things happening there too. So on this periodic returns chart on the bottom right part of this visual, I want you to look at the column for QTR, quarter to date. That's really highlighting what's happened in the first 3 months. Long government bonds and Treasury inflation protected bonds, that's what TIPS stands for, TIPS, Treasury inflation protected, had just a fantastic quarter. I mean, up more than 4% for each of those categories. We mentioned earlier the bond market as a whole up 2.78. Global bonds had a good run, whether they're hedged or unhedged, had a good quarter. And then even short-term bonds had a good quarter at a little more than 1%. Municipal bonds slightly down. Probably what's happening in that market is a lot of the cost-cutting measures that's happening at the federal level is likely affecting some of the municipal bond market as investors try and digest exactly what impact might that have on local and state governments and the funding that they rely on from the federal government, since counties and states and municipalities and colleges and all these different things that have tax-exempt bonds borrow money, and some of the support that they have financially comes from the federal government. And if that changes in a major way, then what does that mean for their bonds? So a little bit of bumpiness in the municipal bond market, but when you look at the rest of the bond market, specifically longer-term government bonds have had a pretty good start to the year. And so from that standpoint, things have been good. So what really has been driving all of this movement in the first quarter, and it's really 2 things, the major level of workforce reduction in the federal government and federal spending really started the year off with a lot of new information that the investment markets needed to digest. But then above and beyond that, all the talk about tariffs, what I've been calling the tariff tantrum, whereas the market's really just trying to figure out what is it that is going to happen here. Is this a serious policy? Is this a policy that is going to be a negotiation tool? Is this somewhere in between? And that's what none of us know. There hasn't been really a clear statement as to exactly. There's been conflicting messages from the new administration as to exactly what is trying to be accomplished with the tariff policy. There are several things that we know for sure. We know that in terms of tariffs, that we are not going to be able to replace the income tax with tariff income. There's just no way that's going to be able to happen based on the size of income taxes that come in each year for the federal government and the potential size of tariffs that would be implemented. So we're recording this in the middle of April. Usually I don't do this, but what I will do is include some of the new information that we learned in the first week of April, which is on April 2nd, the president released the tariff policy that they're intending to implement. And the markets originally, number one, I don't think really took the idea of permanent tariffs that seriously. I don't think there was a huge consideration for that being a reality. I think the markets believe that any tariffs that were going to be announced were going to be more of a negotiation tool. And I think on top of that, the markets expected that maybe a 10% tariff is what might be applied to certain countries, or a handful of countries, or maybe at worst a 20% tariff. And ultimately what was announced was a 10% tariff on almost all countries that we trade with, almost, basically all of them. And then reciprocal tariffs on top of that based on projected trade deficits that we have with each of those countries. And every major economist that's ended up looking at this plan has really two thoughts as it comes out. Number one, nobody can really actually figure out exactly how they calculated what the deficit really was in trading with each of these countries, because the math doesn't really shake out clearly. And then number two, that tariffs in general, from an economic standpoint, mostly end up being a losing proposition for all parties, right? So you have the U.S. Imposed tariffs on Canada, and then Canada retaliates against the U.S. And ultimately, if some type of deal is not struck, then what ends up happening is just simply less trade for both countries. And while that may protect certain industries, for the country economically as a whole will be a net loss on both sides. And so here we have a visual from Capital Economics about U.S. tariffs hitting their highest level in more than a century. The average U.S. tariff rate, if the new administration's plan is implemented, will jump on average to 22%, which would be the highest that we've seen since the early 1900s. The famous Smoot-Hawley Act of the 1930s that raised tariffs dramatically during the Great Depression to try and protect certain U.S. industries ultimately ended up making the Great Depression worse. That has been widely studied. That's actually part of the reason why tariffs have come down so much over the last 50, 60 years, is because economists, as they have researched how that impacted the U.S. economy and the global economy, have come to the conclusion that encouraging free trade throughout different countries would help not only expand economic production for everyone, but also would end up improving poverty levels, raising capita per GDP, so ultimately individual wealth on average per citizen of all countries involved. So as you look at tariffs as an economic policy, they can be used to try and prevent or protect certain industries, but as like a blanket economic policy, widespread belief that type of policy is going to lead to a slowdown in not only our economy, but everybody else's economy as well. And so generally, not a positive, right? The markets did not think that was positive. So when that information came out on April 2nd, the markets, the S&P 500 as a specific metric to look at, quickly lost about 12% over the course of a week. And then what started to happen is the U.S. Treasury bond market actually started to crack as well. So initially, when investors get scared, typically of the stock market, typically what they do is they sell stocks and they go and buy U.S. government bonds. That's a pretty common thing to have happen if investors get scared. And that started to happen. So the yield on the U.S. 10-year Treasury dropped below 4%. It started the year around 4.8% and had dropped below 4%. So initially, investors were running to the U.S. Bond market as they were concerned. And then around April 6th, 7th, and 8th, the U.S. Bond market, the Treasury market, started to crack. And what I mean by that is there was a big reversal where then investors were so concerned about this economic policy, since there was no deal struck, no reversal in the first week, that investors actually started to sell off U.S. Treasuries as well, which is could be a real problem for the U.S. government, since the U.S. government, helps fund the majority of its expenditures by using the bond market to borrow money at relatively low interest rates day to day while it waits to collect tax revenue. And so from a financial perspective, for the U.S. government to have the U.S. Treasury shoot all the way down below 4% and then quickly reverse back up to 4.5, with pressure from investors saying, we think this is such a bad policy that we don't want U.S. stocks or U.S. bonds, that I think ended up rattling those in the new administration, their belief in maintaining this policy going forward. So ultimately, as we look on April 9th, the president announced a 90-day pause on implementing these tariffs. The investment markets rallied strongly on that day, with many portfolios up, depending on your risk level, 3, 4, 5, 6%. The U.S. stock market, the S&P 500, was up around 9% for one day. So think about the volatility of that first week, right? A decline in the S&P 500 of about 12% over the course of just a couple of trading days, and then a quick reversal back upward of 9%. I mean, investors were whipsawed during that first week and a half of April. And so at this stage now, the investment markets sit and wait, right? 90 days, clock's ticking. Who is going to strike deals to avoid some of these giant tariffs that may be applied? How many will strike deals? China has seemed to make it very clear that they don't intend to strike any type of deal, since they just continue to have a tit for tat back and forth on raising tariffs on each other. And the real problem, I think, is not only which tariffs stick and which don't, which countries strike a deal, which don't, what do we get in return if they strike a deal with other countries, and what impact does that have, but also just simply the longer that this goes on. You can see consumer sentiment is falling off a cliff. The average person, the average U.S. citizen, is becoming more and more concerned about what impact this will have. And so from a psychological standpoint, there's concern about, if enough people are fearful about the economic situation going forward, are they and will they pull back spending to become more cautious? And if enough people do that, a recession could be simply a self-fulfilling prophecy. We could tip ourselves into recession if everybody collectively gets a little more conservative. I'm not predicting that that's going to happen, but that is the type of economic reality that this policy is teetering with, is right on the edge of having be a reality. The longer that this tariff uncertainty hangs over everyone's head, think about businesses trying to make capital expenditure decisions in an environment where you don't really know if these tariffs are going to apply or not. You don't know how high ultimately they might be, or if they're going to get negotiated down or completely away. It makes a kind of a scenario where so many different parties in our total economy are either on pause or doing cautious things when normally they wouldn't, if they just knew what the rules were going to be. If they could just understand what the ground rules will be, or what the costs will be to do certain things, as opposed to having, major economic policy change day by day. And so from an economic standpoint, the longer this goes on, the more negative effect ultimately will result. Now, does that mean that investors should sell everything? Absolutely not. Absolutely not. And there's a lot of reasons for that. First off, the U.S. economy was in pretty good shape coming into this first quarter. And even though it may have a bit of a slowdown from what's already happened and what may continue to happen, The U.S. consumer appears to still be mostly spending at a normal level. Interest rates, if they do continue to come down a little bit, so like mortgage rates have come down a little bit starting the day, that helps the housing market, which is a part of the overall economy. So that aspect may help. The Federal Reserve, if inflation continues to moderate, may cut rates later this year. We'll see. So that could help the economy. This economic policy could go away. I mean, there could be a bunch of deals struck or so-called deals struck, and many of these tariffs go away, and then all of a sudden some of that economic concern is gone. The stock market, every single day, every second of every day that the market is open, is reflecting new information in current stock prices. So to say something like the longer this tariff policy goes on, the more economic damage it might do, stock market's already reflecting that. That's not going to be new information. It's already implemented in current stock prices. That's why U.S. stocks are still down for the year, is because they are expecting some of this to have a slight negative effect. But also the stock market is forward-looking and definitely will look past any like temporary economic slowdown that is self-inflicted. Like the stock market, if they think it's going to be just one bad quarter and then things will be back to normal, will look right past that in terms of pricing stocks for future growth. So that, number one, doesn't lead us to believe that we should make any major change in our stock holdings. And certainly selling stocks while they're down has never been part of our investment policy or strategy. But again, on top of that, a big chunk of the stocks we own are actually doing really well this year, partially because this policy has also created the U.S. dollar to go down dramatically. So for as of April 16th, the U.S. dollar, the ICE dollar index, is down 8.5% for the year, which essentially means against a basket of other major currencies like the euro and the yen and pounds and all these different currencies outside of the U.S., the value of the dollar has gone down. What that has meant is there has been wind behind the back of your international stock holdings, because if the dollar goes down, then the profits that are earned by international companies in a different currency are worth more when they're exchanged back to U.S. dollars and paid to you as the investor. On top of that, beginning the year, and we covered this in past quarterly commentaries, beginning the year of 2025, the valuations of international stocks, the price you would pay to get $1 of earnings, was much, much lower than what it was in the U.S. So like if you were just a pure value investor, you would say, starting on January 1st this year, you would have said international stocks look a lot more attractive than U.S. stocks based on current prices. If you then add currency changes with the dollar going down, providing extra financial benefit to invest in international stocks, and then on top of that, you have one of the most conservative, financially conservative governments in Western Europe, Germany, announce a major government spending plan to boost defense and boost their economy that really somewhat surprised the investment markets. You have a backdrop of new information that strongly supported new investment in international stocks. And so it's been very, very interesting to see investors all of a sudden clamoring for international stocks when previously that was a pretty unloved category. And this, really goes back to our overall mantra, right, of we should diversify our portfolios and not try and predict which category is about to be a winner and which one's about to be the losers, because new information that is not predictable ultimately is what will drive future returns and future changes in stock prices and bond prices. And so we don't have to predict which ones are going to be the winner in the short term. and certainly not in the long term. We just need to simply have a diverse portfolio and stick with it through thick and thin. Now, having said that, if certain categories start to get far enough out of balance, we will rebalance them back towards our targets. So we'll sort of lock in some of the profits of any categories that get really overheated or have a really big run upwards. And maybe there'll be some type of reversal throughout the back half of this year or next year. But current moment, international stocks looking like the investors' the investment market's preferred category as of 3.5 months into the year. So that's a somewhat short recap of all the major news headlines that have been affecting the investment markets for the first couple of months of the year. It has been a bumpy ride for sure, coming through the first 3.5 months of 2025. But given all the new information and given that volatility, the investors that have stuck with it still remain in good shape, for long-term positive returns. Like I said, bond market's looking good, international stocks looking good, U.S. stocks temporarily down. But with any luck, with some clarity on future economic policy and the tariff policy, we would expect that in the long run, investors will be rewarded for sticking with it. So for that, this has been your first quarter 2025 commentary. I'm Steve Elwell with Level Financial Advisors, and we'll talk to you next quarter.